Last week, I showed you why covered call ETFs aren't investments. They're cash flow engines, machines, tools, purpose-built to continuously convert equity volatility into cash flow. And when you manage and maintain a fleet of them for what they produce and not what their resale value is, you create long-term sustained income for the owner of that fleet. In the last video, we focused on the concept, the analogies, the metaphors, and the mental model. But a metaphor only matters if it transforms how you operate in real life. So today, we're taking the next step. We're turning metaphor into machinery, concept into practice, and doctrine into operation. That's why today I'm sliding open the hangar doors of my PIIverse, my fleet of 35 different cash flow engines, anchors, boosters, and juicers. Each one with a job to do, each one with a torque rating, each one contributing to the business goals, generating constant, sustained cash flow. And these cash flow engines don't run themselves. So we're going to talk about how my PIIverse fleet is managed, how engines are maintained, how the fleet grows, how risk is addressed, and how the business assures reliable monthly payouts to the owner. So let's dive into real-world, real operational examples of a fleet of cash flow engines. Let's look inside my hangar of PIIverse fleet. Please take note of the following disclaimers. This channel does not provide financial, investment, or tax advice. I am not a licensed advisor or registered professional. I am a retail investor sharing my personal opinions, experiences, and lessons learned along the way. Nothing in this video should be interpreted as advice or recommendations. Every viewer is responsible for their own research, decisions, and outcomes. Your financial situation is unique, and you should always consider speaking with a qualified professional before acting on any information. I might be right, wrong, or somewhere in between. They are just my personal perspectives as an individual investor. As such, all content in this video is for education, discussion, and entertainment purposes only. Also note, past performance does not ensure future results. Thank you. Okay, now that we've got the very important disclaimers out of the way, and they are important, so please take them very seriously, it's time to get started. This should be a fun journey in transforming metaphors into actual machinery and operations. So let's get started. Hello, my name's Perry, and welcome again to the PIIverse. I will be your host today, as I am all the time. Anyways, this video, as the hook had already explained, is going to be taking my last video, which you can see down in the bottom corner here, that was all conceptual. It was bringing up the concept, the metaphors, the analogy that a passive income portfolio made up of covered call ETFs, it basically said, don't think of them as investments and you're basically running a portfolio of covered call ETFs as investments. I really wanted to change the mindset for anyone that's a passive income investor and look at passive income investing in a different light. Because the problem we've had, and it's explained in the video, is that there are several investors out there that are trying to do the passive income strategy, but they still are sticking to the old ways, the traditional growth investing metaphors and rules and concepts, which is really making it very difficult for them to actually embrace the passive income mindset. Because honestly, nothing wrong with growth investing, but income investing and growth investing are two fundamentally different types of investing. And if you hold on to the old regime that basically talks about growth investing and NAV appreciation and holding investments to appreciate their NAV and their resale value, you really are going to struggle in making passive income investing successful, because you're going to be struggling. You're going to be wanting to be pulled into ways that you shouldn't want to be pulled into. If your goals are continuous cash flow generation on a monthly basis and something that'll continue and grow over your retirement years or your income consumption years or the wealth consumption years, you're going to have troubles doing that if you keep holding on to these covered call ETFs and treat them like they're growth stocks. You're going to start trading them when they're high, trimming them off often thinking that, oh, I'm going to appreciate value on them. And again, if that's your way of thinking and if that's your goals and your strategy, that's fine. But then you really are not a pure passive income investor. You're very much hybrid, or you're still really entrenched in the growth methodology, and you're just using covered call ETFs as a weird form of growth stocks. So the first thing I'm going to ask in this video, what we're going to do is take conceptual into actual. I'm going to walk you through how my PIIverse passive income portfolio, made up of several, and you heard 35 different cover call ETFs in my portfolio. And I'm going to transform the way I talk about them as portfolio and cover call ETFs and investments. I'm going to be using the analogies and the metaphor in the video. So the first thing I want to bring up is the fact that down here, you can see down in the bottom corner, that is the video that I created only about 4 or 5 days ago. It was published on March 14th, 2026 for those that are looking for it on my channel. I'm going to put a link on it right now, right up there. Look. Up there, I'm going to do the link. So if you have not seen this video and you look at this past video and you're just going to this video first, it really is going to hurt the power of the message of this video if you haven't seen that video. So I would put this video on pause, go watch that one, and then come watch this one. If you don't want to, fine. But I'm just saying, for efficiency's sake, it's going to have a lot more meaning if you watch that video first. Okay, so again, the way, just to recap what that video said, and it's 22 minutes long, so it's not actually that long. It basically says, don't treat covered call ETFs as investments. You're going to treat them as if they're things called, these assets called cash flow engines, almost like a modern form of annuity. And again, we talk about that video on what's the difference between a cash flow engine and an annuity. So that's in there as well. Then we're going to say that if you have a whole bunch of them together, you have a lot of these cash flow engines working in your portfolio. We actually turn the term portfolio into fleet. So we hold a fleet of cash flow engines. And then the other thing we're going to talk about is, how do you manage that fleet and why are they managed differently? We bring up the concepts which are pretty radical in the investment world, where people say, well, don't worry about NAV. Well, if I actually say that, I get a lot of comments from people saying, what do you mean don't worry about NAV? NAV appreciation, you should always worry about NAV. In this actual, I'm actually pushing the boundaries on this one and saying, no, you don't have to worry about NAV. It's something that you would like to see. You'd like to see your cash flow engines basically appreciate in value, but you're asking for the cake and eat it too, because cash flow engines, or covered call ETFs, they were designed to transform NAV appreciation into actual cash flow, into capitalized gains. So you can't have something that's taking NAV appreciation and capitalizing them into gains and then still wanting NAV appreciation. It's sort of like, the cake and eat it. So if you get NAV appreciation and you're also getting some good consistent cash flow on a monthly basis from these engines, these cash flow engines, that's great. That's a bonus, but you shouldn't expect it. And the reason you also have to look at them is, in the world of passive income investing, you're not looking to hold assets, or you're not looking, in their case, to hold investments. These cash flow engines are bought and held. So we're following a very strict mantra of buy and hold, not buy and hold until you see an opportunity that the price has gone up and I'm going to try and make some gains on it. You really, and again, nothing wrong that you can't do that on the occasional basis if you can find a strategy on where you want to move those gains to. But for the most part, you're buying these cash flow engines to stay in your fleet for as long as possible, unless there's a reason why you have to get rid of them. And again, NAV depreciation or NAV erosion or NAV lag, in many cases, is not the reason. It's because it may not fit your philosophy anymore. There may be a more efficient way of having another engine similar to it. But to get rid of it out of your fleet just because it's depreciating in NAV it's radical, but it's not part of managing this fleet, because I'm buying and holding. And until there's a reason otherwise, no matter how far it erodes, and I'm going to show you actual examples in my fleet of how bad situations get, and I'm still not selling them. I'm still not getting rid of them or retiring them from the fleet. And I'm going to show you why. So this is why we're talking about fleet management, and we're going to talk about how cash flow engines work. And I'm going to give you real world examples of how I manage my fleet. Okay, so I hope that helps. Again, I'm a very long-winded person. So for those that are watching my video, please refrain from the comment is you talk too much. I know I do. That's the way I live. So if you don't like it, press fast forward or skip 10 seconds at a time. All right, so what we're going to do, we're going to go over to, I'm going to call it, I usually call it my portfolio spreadsheet or master portfolio spreadsheet. For this video, I'm calling it the fleet inventory spreadsheet so that you can keep grasping the metaphor that I have a whole fleet of cash flow engines and I'm managing the fleet. And we're going to use many of the terms and ideas used in that previous video and show you how I actually use those terms and those concepts inside my actual management of my fleet, and why my fleet, at least 2.5 years into my retirement, is still very successful. It's growing, it's producing more income than I need to retire. And so we'll see how this works. All right, so let's go. Okay, this is, for today's video, this is my cash flow engine fleet spreadsheet. And let me just arrange things here on my screen so I can make it work better for me. Again, some people are going to say that this spreadsheet is too big and too small to read. If you're on your phone, I apologize. It won't look good. I'll tell you right now, because it's going to be very small. You should better watch it on a PC monitor or on your TV would be about the best way to watch this. So let's get started. So I'm going to show you, this is my main tab. And again, many of you that have followed me and subscribed to me know what this spreadsheet looks like. But for those that are brand new to it, this is my master spreadsheet. It's evolved over the past 3.5 years. It's very complex. And I'm just going to give you a quick tour. Over on the right here, on the left here is basically all my assets or all my investments. And we're going to talk about those later. Down at the very bottom is my main portfolio spreadsheet tab. So that's the tab we're on now. I just want to tell you, those people that don't know, my portfolio is actually made up of 4 retirement income funds. I'm Canadian, so these are sheltered retirement funds called RIFs. RIF, retirement income funds. I actually have 4 of these accounts. So I have mine here. And by the way, I apologize because they're all in different locations. I have my wife's, I have what's called my LIF, which is a special form of RIF, and I have a prescribed RIF, which is another special form of a RIF. I have my non-registered, which we're not going to be talking about much. I will talk about this only briefly because it's very important to bring up, but not much. And then I have my TFSA, which is a tax-free sheltered account, and my wife's tax-free sheltered account. So I have generally 6 accounts that make up my PIIverse fleet. Inside each one of those accounts, or I'm going to call them, let's say I have 6 hangars in my fleet. Each of them basically has a fleet of vehicles that are managed independently inside of one of those hangars. So my RIF has a whole bunch of cash flow engines. You can see them right here. My wife's has that. They all generally hold the same assets, but just different numbers of holdings, or some may not hold them and some may hold them. But because each one is their own account, or I'll call them their own hangar, they all have different rules. They all have to be handled or managed separately. So they're like different hangars of my fleet, but they generally all hold the same assets. So if I have HHIS, they all have the ability to buy HHIS. They may not all do it, but they have the ability. Okay, so what we're going to do is I'm going to first talk about, and this is a big elephant in the room. When I released that video a few days ago, one person's question came up, and I'm glad this person asked this question because this is a very critical thing to say. The person asked the, let's say, provocative question, say, Perry, you talked about covered call ETFs would be your cash flow engines for your fleet. Why can't you just hold the underlying stocks in these covered call ETFs and just hold them as basically growth assets? Because the assets inside a covered call ETF almost always invariably are at minimum pure growth stocks, or they're growth with some dividend stocks, but they're not basically income generating assets. They are equity stocks of which the manager, the ETF manager, writes basically covered call or derivative contracts on it, which generates monthly cash flow or weekly cash flow. So the person asked me, well, why don't you instead, because it's way more efficient and basically has better capital gains and all the arguments that growth investors use. And they says, why can't I just do a fleet of managed assets and those assets are all growth stocks? Answer, it does not work. So the first thing is I have 3 of them that are my example: Athabasca, HMR, and PEI. These are pure growth stocks. Since none of the 3 generate any monthly income, they are pure growth stocks. They can't fit into a cash flow engine. They don't generate cash flow. The only way they generate cash flow is if I erode them or sell them. They're only valuable to me as actual cash when I actually resell them or sell them for a profit or sell them for a loss, whatever I'm selling them for. They generate 0 cash for me on a consistent basis. So to the person that asked the question, why don't I basically do cash flow engines made up of equities and then I could just basically sell them off? Well, that is not part of this entire concept. Now you're not managing cash flow assets. You're almost like a collector, and you're hoping that the collection of whatever you hold, collection of cars, collection of postage stamps, you're just hoping that they appreciate in value enough so that when you retire, you could start selling them off, melting them down, eroding your collection. That is not managing a cash flow. That is basically selling off your inventory. And that is, since we're not in the business to sell off our business, we are in the business to maintain the business for the next 20, 30 years and to basically produce a growing monthly flow of cash for the rest of my retirement life. Having pure growth stocks does not make sense here. So, sorry, that's a long-winded answer, but it does not work with growth stocks. You cannot follow a fleet of cash flow engines where your cash flow engines don't produce cash flow. Okay, so I hope that one is gone. So these 3 here that you can see right here will not be part of the story because they are outside of my fleet. They are treated completely differently. So my fleet is made up generally of these 35 assets right here. You can see they're right here. And again, this is my portfolio. So this is an aggregation of all of my accounts or all of my hangars. It's almost like they're all the hangars are sending their books up to the main guy. This is the main guy. All right. So let's talk about examples of the cash flow engines. We primarily have 3 types of cash flow engines. We have the anchors, we have the boosters, and we have the juicers. And in my inventory, my fleet inventory, I actually track them. So I'm going to go way over to here. And I'm going to show you where they are. So anchors, and for those people that don't know don't follow my channel, anchors are considered my low torque. So when we talk about the video, we talked about torque. So if it basically is an anchor, it means it has a yield under 25%. They typically all use composite underlyings, but they're very stable in NAV, very stable in yield. So when we can go back to the previous video or the conceptual video, anchors are those low torque, low wear. They are basically your heavy duty engines. They basically run. It's like a tractor versus a Formula 1 racing car. These would be your tractors. These are the ones that will run for years and years and years and years. They take very little maintenance compared to the F1 Formula car racers. They don't go high speeds, but they just know how to chug along. So if you have one, for example, HYLD, and I'm going to use that as an example. Sorry for the clickety click. Sorry, I have it over here. So this anchor here has basically a 6-month average yield of 13%. It will likely follow that for infinitum. If you look at what I mean by stability, these anchors generally don't change in monthly distributions. If they do, they typically, on most cases, go up, not down. If they do go down, it's very rare. But just show you an example here. HYLD, this is the 6-month distribution of HYLDs. And you can see it actually only changed once. And as it over here on the 6 months ago, it moved up. And it's basically the same distribution every month. HDIV, another one of my anchors. It's basically a low torque, low wear engine. It runs forever. You can typically also see that not only are they very stable in their distributions that they hand out. You don't say, oh, gee, one day it was 13 cents and the next day the next distribution is 25 cents and then it's 5 cents. These guys are almost the same every month. The other thing you notice about the anchor cash flow engines in my fleet is that they typically don't have much of a down nav. They're actually, not only are they producing monthly income, but they produce it and actually appreciate in value. So they are becoming more valuable in my fleet, as well as the fact that they are producing income. Their income is not as much as a Formula One racing juicer or as a stock car booster, but it basically does produce it actually does in many cases produce or generate an unrealized gain. So you can see here, CDIV or HDIV is up 42%. My HYLD is up 17%. Now, that being said, it's very important to know, back to the metaphor and the concept of managing a fleet of cash flow engines. Having a cash flow engine like HDIV that is not only producing the yield it does, so in this case, for me, at my yield on cost, it produces me a 15.2% yield, which is a pretty good yield. But it also is appreciated in value 42%. If I sold my HDIV right now, I'd actually make a 42% realized gain or capitalize a gain. But here's the thing. When I'm managing a fleet, since I have no intention of selling the business, since I have no intention of selling any of my cash flow engines, you could see that having an unrealized gain of 42%, the only thing that's nice about it is that it's not eroding or it's not lagging. It's actually appreciating. It does not produce me any more income. This 42% gain is unrealized. I'm not getting another 2 or 3% on this. This is basically will remain unrealized unless I actually sell the car or sell the cash flow engine. Since I have no intention of selling it, the only thing you could do as part of cash flow management and asset management is I could consider saying, you know what? I could consider trimming its gains. In other words, I don't want to sell off this asset because it's such a valuable asset and it's actually generating a very steady income for me, cash flow income year in, year out. But if I actually sold, say, 452 of my 1500, I would actually trim out all the gains from it and get the cash from that gain. And I could go and put it into another cash flow engine. So I'm not realizing the gain so I could give it to the owner. And when I say give it to the owner, for those that didn't watch the video, giving it to the owner means paying it out of the portfolio and giving it to the retiree so he could use it to pay bills. That is not the intention for realizing gains in my cash flow fleet. If I'm managing my fleet, I'm going to rebalance. This would be a rebalance. So I would, in this case of the anchors, I would be selling off 452 of my 1,510 shares or units of this. I would realize a gain of $9,324. And I would then go look for another cash flow engine or adding more money and buying more cash flow engines of something that produces, more than 15% yield. So at or more, if I either want to diversify or I want to add it to another engine and add a little more capacity to another engine. So this is the whole concept of fleet management, is rebalancing and actually, if you're going to capitalize or trim gains, you're doing it only because you could find a place to put that extra money into something that yields even more. So that is an important thing when we talk about cash flow management. I do that on occasions. I don't do it that often. I did it with PLTE when it was really up at 90%. Unrealized gains, and I took some of that and trimmed it because I moved it into something else that could generate as much yield, and it helped diversify my fleet. I did it also with bank. I moved bank some of the gains and some bank into 60, which is a newer ETF that generates more yield than bank, but does pretty much the same thing as bank. So that's another rebalance where I've basically trimmed off some gains from bank and I moved it into a new holding called 60. Again, this goes into fleet management. I don't sell off or trim my gains and basically pull it out of the fleet and give it to the owner to use for living expenses. It's used to rebalance and grow the cash flow or grow the fleet. Okay, so those are examples of anchor cash flow engines. Then I have boosters. Boosters are things like HHIS. It's a booster cash flow engine. I have a lot of them down for a lot of my American ones are boosters. So QDTE, RDTE is a booster. It's a cash flow engine. Now, why are they cash flow engines? Why are they called boosters? In my category, a booster is something that it still holds composite underlyings, meaning an all-in-one underlying, an index underlying, or a mix of several underlyings put together that they built up together. That makes them composite. And they must produce a yield that generally is over 25%. So they are basically anchors with on some more steroids. Okay. So boosters, they are more volatile. So you can see they're more volatile. I'll just use a couple examples of boosters. They're not always. The closer they are towards the spectrum of being an anchor, the more stable they are. Because if you're closer to 20, 25% versus 60, 50, 60%, obviously you're going to be more volatile. So this is QDTE is a good example of something that's more on the spectrum of being more volatile. Its 6-month average yield is 58%. That's not a good example because it actually had a couple big payoffs. So currently it basically was 29%. RDT is another one that's at 37%. They're all over 25%, but you could see that their monthly distributions are a lot more volatile. You don't know from month to month, and these are actually weekly payers. So you don't even know from week to week how much they're going to pay. So they are generating cash flow towards the fleet, but you have to manage them differently than anchors because the expectations you have on boosters are different than those you have for anchors. With boosters, you basically know that some months you're going to get less from them, some months you're going to get more from them. The nice thing about fleet management is that all the distributions from all the cash flow engines go into one bucket. So some may be very volatile, some may be very stable, some may be up, some may be down. The good news about that is when you put it into a big bucket, generally the bucket, the cash flow revenue, it moves, it may go up a couple thousand over the previous month, or go down a couple of thousand over the month, but it basically blends into a much slower moving ups and downs on your cash flow. You have to expect with boosters that boosters are going to be more volatile on their distribution than they are with anchors, of course. The other thing you're going to notice with boosters are they are more volatile. They're not more volatile only on distributions. These cash flow engines you have to expect are going to have more NAV lag or NAV erosion. In the metaphor, this is basically what we talk about engine wear or engine maintenance. So because they run a little hotter than those of the anchor, these engines on these cash flow engines basically have more wear and tear. They run, for example, since I've held QDTE for almost 2 years, QDTE basically is down in NAV 31%. So it's definitely shown more wear than if you go and look over up here at HDIV, which I've held for almost over 3 years. It's 3 years and I'm up 42%. And if you look at RDTE, I'm down 35% in under 2 years. So this guy definitely runs hotter, produces a lot more income, because where HDIV was generating 15% yield, you're looking at something that's generating 40% yield. So they run hotter, they produce more income, but they're more volatile in distribution, and they're definitely more expected. And again, I don't look at it with shock. I'm like, okay, it's running like a booster does. I do expect NAV erosion now, or NAV decline or NAV erosion. Now, before I even get into juicers, which are even more exaggerated on this, I got to call this out, because people This is where it's different when you're managing a pure passive income portfolio or pure passive income fleet versus if you're running a growth portfolio. If you're running with a growth portfolio mindset, you're like, oh my God, Perry, look at this, 35% down. These are losers. Why would you've held these investments for under 2 years and you're already down 35%. So here's the thing. I don't look at this as, would I like it to be zero? Sure. It'd be great to have an engine that produces this much income and also has no wear. First of all, it's the utopia type solution, which there's rarely any ones of it. You don't get this kind of yield, such as this one here, RDTE. You don't get this kind of yield with a 37% yield and expect it to not have any kind of engine wear. It's basically going to have engine wear. Now, that being said, somebody's going to say, well, what happens when it gets to zero? Well, here's the other thing. Covered call ETFs will almost never go to zero because they are constantly writing covered call contracts or derivative contracts on the underlying. So the only way generally that this ETF or this cash flow engine can reach zero is if its underlines itself actually delisted or actually went bankrupt. So if you're saying that the S&P is going to go bankrupt, or if you're saying that the NASDAQ, RDT is based on the NASDAQ, if you anticipate that the NASDAQ is going to go bankrupt, well then, yeah, we're going to hit zero. And I'm sure a lot of you people are laughing saying the NASDAQ will never go zero. No, it won't. And because it won't go zero, Roundhill will keep writing derivative contracts on the NASDAQ underlying index. And therefore, this will keep going down. If it gets too low, we've seen pure examples of what happens when it goes too low. All the covered call ETF managers do is they reverse split it, lift it up. It's definitely eroded in its value, but it will keep on producing income. It will keep declining, and I'm going to show you examples of it, but they are constantly generating cash flow. It may be less and less each month, and you have to sort of expect it. If you're asking to hold more boosters, boosters run hotter. They generate more torque, and you're getting more torque. If I actually compared the torque or the distributions that I get out of something like RDTE, and we're using RDT as an example, this guy basically is generating $665 versus HDIV, which is generating me $276. And if you look at how much the investment is between them, they're both, one is basically 35,000 versus 20,000. So he has a little bit more income on, but he's generating over 2 times that amount. So he's generating more income even when he's been eroded. If you went back to its glory days when I first had RDT, it was generating, I have to find RDT. It was generating this is 6-month average. It was generating about $1,200 at one time. So, and that was realized gains. Those were realized monthly distributions that I pulled into the fleet. I basically redistributed it and bought other things with it. So yes, it's down now, right now at 665 because it's eroded 35%. But its past months in its first year of operation, it generated a ton of monthly income, of which that income was redistributed and invested into other cash flow engines. So as much as you can see a lot of red here, 35 down, 32 down, 58 down, all these like this, as much as you see them down, a lot of people forget they've generated so much cash flow over the anchors, and that money went back and redistributed to grow the fleet. My fleet, when I started about 2.5 years ago, let's say in 2023, my fleet size at NAV was $1.28 million. My fleet right now is $1.55 million. It's growing that much more in the past 3 years or 2.5 years. And the other thing people forget is in the past 2.5 years, I've lived on this portfolio. I've lived on this fleet. So in addition to that, it's gone up almost $300,000. It also paid out almost $400,000 or $500,000 out of its fleet and to the business owner. So it's actually even larger than that. So not only is it paying me, but it's also growing the fleet size. And that was much attributed to not the anchors, but the boosters. And we're going to talk about the juicers. So let's talk about the juicers. Juicers are the F1 Formula racers in my cash flow fleet. These are the ones that generate by far the most yield. Often they generate yields greater than 50%, 60, 70% in some cases. Some of them are crazy in the amount of income of yield that they produce. In other words, back to the term, they have amazing torque. They're F1 Formula racers, amazing torque. But they are, just like a F1 Formula racing car, they're extremely finicky. They only operate at prime conditions when you give them the best road conditions. In other words, try to put an F1 Formula racing car on a gravel road, or try to put it on when it's snowing and wintry out. Whereas the anchors would have no problem doing it. They would actually drive right through that snow. They would drive right through that, gravel road. These juicers have a lot of troubles with them. If the road conditions are bad, in other words, if the global markets are bad, or if the sectors that they're in is really bad, you're going to see them really start pulling down in their performance. They're very volatile. So whereas the boosters are volatile, the juicers are very volatile. So something like AVG, I'm just pulling up one as an example. AVG, its current yield, 6-month yield is 77%. Its current is 47%. Some of them are even higher. Like let's look at, for example, Misty. Misty is basically at 64, 65%. And I'm going to use Misty as a perfect example. I've held Misty for 2 years now. This number here is saying 24, that's 24 months. So we're going to talk about Misty as the poster child example when we talk about managing your fleet of cash flow engines. Misty I've held for 2 years. Misty has generated amazing cash flow over those 2 years. In those 2 years, it is now down 85% NAV. So basically right now, where its book cost was $84,000 in my cash flow fleet, its current value is only $12,000. Now, if you're a growth investor, you are laughing your head off and you're saying, oh my God, what a waste of money that one is. Well, here's the difference. And this is why income strategy and growth strategy are totally different things. Since I'm buy and hold, I don't care that it's down 85%. Would it be nice if it wasn't 85? Would it be nice if it was 0? Sure it would be. But since I'm in a buy and hold mentality and I basically hold Misty for the income that it generates, even though it's down 85%, look at this guy. He is still, even with a net value currently at only $12,000, he is still generating $621. If you go look at HDIV, HDIV is only generating less than half of that. So we are talking about an asset which a growth investor would have basically sold off and basically, claimed a loss on this one and says, I've wasted my money on this. I still look at Misty as he's doing exactly what he's meant to do. I've had him for 2 years. He's still on a monthly basis producing me $621. Since I don't look at the resale value of my cash flow engine, I don't look at, oh man, if I sold it, I'm going to lose 85%. I don't even look at it because I am a buy and hold investor. I will be holding Misty likely for another 2 years, 3 years. Will it maybe get down to about 95% NAV loss? Maybe it will. And will my income drop here from what it was at 621 down to maybe 300? Maybe it will. But here's the thing. This juicer, I'm going to go way over to here. This juicer has generated over the 2 years that I've held it, $82,440 of distributions, actual cash that flowed into my fleet since I've held it. So yes, I've had it for, I basically lost 85% on it. I'm still up. Because I basically, even though I'm down $71,000, I've made $82,000. I'm still, so somebody says, well, you should look at total return. Well, look at my total return. My total return on Misty, even though it's down 85% right now, I still have a total return of 12%. And again, even that number, yippee-ki-yay that I'm at 12% positive ROI. The big number I care about is how much has it paid out. It is now 97% away from basically paying back my entire initial investment. But Since I have no intention to resell this asset, my cash flow engines are buy and hold. I'm going to repeat this 100 times. I don't stay up at night saying, oh, Perry, what did I do? What should I do with Misty? Should I sell it? No, I will not sell Misty, because as long as I hold it, it will continue to produce an actual great yield and a great distribution. And again, I have full intention that it will go from 621 to maybe 550 to 525 over the next years. But who cares? I've already made my money back. In the next, like I'm at 97% cost recovery. In the next couple of months, I will be at 100% cost recovery. Anything it produces in my fleet is now house money. So that is so important, because this is a poster child example of the difference between managing a fleet of cash flow engines and being an income investor, but still treating your cash flow engines as if they are growth stocks. If this keeps you up at night and you're an income investor, then I have to turn around and say you're not an income investor. You are actually a growth investor that wants your cake and eat it. You want the income and distribution of Misty, but you also want it to somehow at least stay stable. But if nothing else, you would love to see it grow. You can't have your cake and eat it. And since I bought this cash flow engine for the income it produces, I didn't buy it for the NAV that it would appreciate. I don't look at this number. Okay, that's important. This is about the biggest thing about cash flow management is that we talked about, is that I don't sell my losers. My losers are not losers. They are doing exactly what my fleet of cash flow engines do: produce constant monthly or weekly income for me. And then basically the money that I actually receive from someone like, quote unquote, this loser called Misty, that some call it, that money goes towards buying other new cash flow engines, and they could be anchors. So I could be using the money from this juicer and building up my stock of anchors, more tractors, more low torque, low wear type engines. So my fleet is still growing, even though I have these juicers in here. That's why I don't stay up at night when I see that Misty is down another 2% or 0.5%. Because I don't look at this number. I look at this number. I look at this number. This is generating $620 into my fleet's cash flow, monthly cash flow, and that's what I care about. Okay? Again, I want to show another thing. And again, these are just to give you visuals of this. So when we talk about income production, this is why it's called passive income. It's not passive in the management of it. In other words, I still have to make sure that when income is coming in, what do I do with the cash that starts building up in my cash accounts, in all my 6 accounts? Do I redistribute it and reinvest it back into the portfolio or into the fleet? Do I pay out to the owner? In other words, do I extract the cash so that I can live on my retirement? Well, there's a balance that has to be done. But here is the things that you can actually see. This is what I see on a week. So this is a weekly basis. This is week 1, 2, 3, 4 of this month. This is the weekly payouts I get from all my cash flow engines. And now, if you look here, you don't look at how much my NAV depreciation is on COIW. You don't look at it on blocks and see it's down 40% or whatever. Here's what I get each week from these weekly pairs. Here's what I get the next week from this weekly pair. Every week this is coming in. This is my current week, which will eventually look like this week once this week ends. But this is what I get every week from my weekly pairs. This is what I get every month from all my cash flow engines. This is my cash flow engines here. This is my cash flow engines here. So this is how much my cash flow engines brought to the fleet for the fleet management to decide, what am I going to do with $36,259? Okay, I know that the owner needs at least $10,000 to live on for his retirement. So $10,000 of that $36,000 is extracted from the fleet and given to the owner so the owner can enjoy his retirement. Then I have to decide, if $10,000 is going out, what do I do with the remaining $25,000? This is the fun part, and actually one of the most critical parts of fleet management. What do I do with the $25,000 excess cash that my owner doesn't need for retirement? I could either take out even more and give it to my kids, which basically is one option. Or I could say, no, what I'm going to do is I'm going to redistribute it and reinvest it back into the fleet and grow the fleet. Because when I grow the fleet and say, okay, so there's 26,000 that I can actually put somewhere else, I will move it into adding more to HHIS. If I add more to HHIS, well, next month, HHIS's monthly distribution will go from 1782 to maybe 1850. So every month, something here is going to go up if I redistribute it or reinvest it. The other thing is, so here you can see 36,000 in January, 29,000 in February. Basically this one will be about 32,000 when I'm finished this month. So my job as fleet manager is to constantly try to maintain and grow the fleet, because if I grow the fleet, I grow the cash flow. This is compounding income. I'm using the money that was distributed out of the cash flow engines and moving them back in excess of what I've already paid out to live in my retirement. For those that don't know me, I live 97% on my fleet's monthly cash flow. I don't have a pension. I don't have anything. The only thing I have is my Canada pension plan, which is not that much. Everything I do to live on my retirement for the past over 2 years has come from this fleet. This fleet has grown in size. It pays my bills, and it generates more than enough money that I can actually reinvest into my portfolio. The other thing I want to point out here when we talk about fleet management, because a lot of people, if you think like a growth investor, you're going to say, well, here, Perry, look, your book NAV, I'm going to go right down here. Your current book NAV for your entire fleet is $2.02 million. Your current NAV is only 1.54 million. You're down like 23%. Like, how could you be happy about that? If you are asking that question and saying, why am I happy about a NAV over book decline of 23% over the 2.5 years since inception, you are thinking like a growth investor. I don't care that this is 23%, 27%, whatever, because this guy might be at 1.54, but remember, I'm always reinvesting. So my book NAV, if it's going to increase from 23% to 25% to 26%, whatever, or if the markets are good, it could go down to 10%. Like, this is changing based on the market conditions and how much each of my cash flow engines are worth. But remember, I don't care about how much my cash flow engines are worth at resale, because I don't plan to resell. So this is going to likely, this has actually stayed in the 1.5 range for over a year and a half. And why has it stayed at that amount? Even though I've paid over almost $200,000, $150,000, $200,000 a year, I actually pull out of it as actual investments to my retirement. And why is it still at 1.54 after that? Well, that's because of reinvestment. So what will happen is sooner or later, I will every month put more reinvest. So this book NAV is going to keep going up. It'll go to 2.1, 2.12, 2.15, 2.17. Current NAV might lag behind it and go 1.55, 1.57. It'll go up as well. If the markets are really bad, like they currently are, the global markets are not good, this guy could actually stay the same or may even go down as this one's going up. This unappreciated or unrealized loss of minus 23%, it may go to minus 27% or minus 28 or 29%, but you will see my current NAV stay around the 1.5 to 1.6 range anyways, and that is because I'm reinvesting. If you're a growth investor and you're retired on a growth strategy, this is not going to happen for you, because if you're pulling out the kind of annual distributions of money out of your portfolio that I am doing, you're going to go down because you have to sell your assets and you actually have to lower. You're basically eroding or melting down your portfolio. As you can see here, as an income investor or as a manager of a fleet of cash flow engines, I'm not selling anything. In the last 2.5 years since I retired, these numbers have not gone down. I have not sold any of these assets. These numbers, if anything, are always going up. Try to do that as a growth investor that's consuming and selling off their assets and living on their retirement on their growth portfolio when they're selling all their assets. Their numbers aren't going up. Their numbers are going down. My numbers are going up because my fleet of cash flow engines has enough to actually feed back in and grow the portfolio while at the same time generate all the money that I need to retire. So I hope this really drills home. I think I got pretty much everything. We did talk about a lot of different topics about the idea of trimming gains. Like, why is it if you're up 42%, why are you not selling and realizing the gains? We talked about that. We talked about the torque and the wear differences between anchors, boosters, and juicers. We talked about why Perry does not care that his NAV on Misty, his poster child NAV of Misty is down 85%, and yet he is more than happy holding it and not having any intentions on selling it. And we talked about the whole idea that my portfolio is down 23%, yet Perry's happy and it's meeting all my goals. It's meeting all my goals. So let me go back to the screen here. Okay, so long-winded. I really wanted to drill this home. I apologize for those people that are not patient and said, Perry, you could have said this in about 10 words. Sorry, you could keep complaining about it. That's what I do. For those that did find it good, appreciate the analogy and actually talking it through in great detail, thank you very much. In general and in conclusion, I treat my PIIverse portfolio or my PIIverse fleet, my PIIverse portfolio of covered call ETFs, just like the video that I hope you guys have watched, which is the idea that I treat my covered call ETFs like cash flow engines. Their job is to produce income. Their job is not I did not purchase them to appreciate their value or to make them be eventually good for resale. And since I don't do that, I don't look. When we talk about total return, on the total return spectrum, I am on the extreme income side of total return. Anyone that says is that you're yield chasing, you're not looking at total return, sorry, you don't understand what the concept of total return is. Total return is the balance between income. It's the spectrum between income and pure growth, pure income or pure growth. Every person that buys an investment is buying an investment with a total return. The big question about total return is how much of your total return is made up of growth versus balance, meaning it basically stays equal, versus it's basically there to generate income. We all, when we buy an investment, have an investment that has a total return. My total return is very income focused. I'm on the extreme income focus. I don't look at NAV appreciation. So do I focus on total return? Sure I do. But my total return is all on income. Anybody that buys pure stocks like Tesla or my Athabasca or stuff like that, they'll say they have total return too, but they're pure growth. They have no income on that. So they are as much chasing growth as they accuse people like me of chasing income. Because there's no income in their total return. Their total return is all growth. My total return is all income. And I'm very happy with that because as a retiree, my goals for investing is to generate as much consistent, growing monthly distributions and income as possible. And so that's my total return. My total return is pure income. If it actually appreciates and has some NAV appreciation and some growth, that's nice. I don't buy them for that. So I can't say that I bought them for growing appreciation. I did it for income. Okay. So I hope you found this valuable. This shows you that that concept in that video that I gave you was not just conceptual and theoretical. I actually follow that edict, that doctrine, that methodology, that metaphor. So I hope I hope you found this all valuable. Please, if you found this valuable, subscribe to me if you haven't before. Like if you have, I really appreciate that. And please leave your comments. I know good or bad, please leave your comments. I look at every comment you give and I generally respond to every comment. Until next time though, stay safe, stay investing, and I will see you in the PIIverse.